Thanks very much, Dave. I'd like to now open up to any questions from any of the first callers. I wonder if we could take our first call, please.
Thank you. If you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press star 2. If you're on speakerphone, please pick up the handset to ask your question. Your first question comes from Stephen Ridgewell from Craigs IP. Please go ahead.
Yeah, good morning, and congratulations on the result, particularly the second half. Just wondering if you could give us a little bit more flavour on the performance in the March quarter, which I think you've called out was a record for the Australian business, but didn't talk too much detail on the New Zealand business. And also just wondering if you could give us a little bit of flavour in trading in the last few months. Obviously, the investors in the market is watching the New Zealand housing data pretty closely at the moment. So any additional detail you could provide would be appreciated. Thank you.
Thank you very much, Stephen. Well, certainly Australia was certainly where the recovery was led from in terms of the sales, and the picture was quite different in New Zealand, where Omicron was, of course, flowing through the country. Cam, perhaps you'd like to just talk a bit more about how that recovery took place.
Yeah, well, we were very pleased to see that it was quite a swift recovery after the Omicron wave in January. So we had close to 100 sales in February and March. What was particularly pleasing for me was that that was all of existing stock. So there were no new stage releases in the last couple of months of Q4 there. And so it was a really remarkable result. Very strong leads, excellent quality of appointments, and significant activity on every site to drive those sales, and I was really pleased with the speed of the snapback.
And Stephen, if I could add, we're certainly seeing significant inquiry, and demand is recovering, returning well. There's no question when Omicron arrived, it was a little more difficult, but frankly, things have really opened up again, and we're really confident about the future and execution of that.
I think there's been quite a significant evolution of our brand through the COVID crisis, in the sense that when the crisis began, many people saw the retirement sector as somewhere where you would go perhaps to risk getting COVID. And I think what played out through the crisis is that we were able to demonstrate actually that we could protect our residents. And what has played out as a result is that our inquiries are now higher than ever before, as people see the benefit of moving into a village now in an environment where COVID is circulating freely in the community. And that, as a result of that, we're seeing some of the highest levels of inquiry that we've ever seen.
All right. Maybe
okay, that's helpful.
Thank you, Stephen. I wonder if
one from me.
Thank you, Stephen.
On the 6.8 billion you've flagged as capital proceeds from the completion of the current land bank. Can you give us a steer over kind of what time frame we should be thinking about for completion of that? I mean, very, very broadly, obviously, but the rough time frame for completion of that. And then is there any steer, even broadly, you can give us for kind of Ryman's aspirations for build rate in FY23? Thank you.
Yeah, sure. I think what I'll do is I'll just hand to Dave, who can talk more about that. We do, of course, take a very long-term view of our real estate. And Dave, perhaps you'd like to elaborate.
Yeah, thanks, Stephen, and thanks, Richard. On that 6.8, Stephen, that relates to the total capital proceeds we would get from those sites. So some of those sites we would have received some of that already. So like your William Sanders development that's already underway. What that is, though, is the total proceeds that those 29 sites will generate. So really, we would be expecting to realise that over the next 4 or 5 years as we build out and develop those sites in our land bank. But obviously, we will be looking to add additional sites over time as well to sort of continue lifting that.
Next question.
And thoughts on the just circling back, sorry, the second part of that question was, are you able to give us any steer on build rate aspirations for FY23?
Yeah, I think with the build number, Stephen, obviously it's something that we monitor closely. We've got really good building blocks in place and all going to plan. We would expect to build sort of over 1,000 for next year. But yeah, we'll continue to monitor that, but that is our expectation at this point.
Great, thank you. And just one last one from me, if I may. Construction costs. You did call out, pressure there, and that's been widely reported, of course. Just with the prices you're getting on new sales and perhaps the demand you're seeing, can you give us a sense as to whether you think you can kind of hold development margin there or thereabouts from what you've reported in FY22, which is around about 24%, or would you might see that to come back a bit this year?
Obviously, very difficult to predict what's going to happen in the housing market. There's very mixed views out there. What I think is very encouraging, though, is that we have managed actually to build our combined margin over the course of the last 12 months, despite the fact that construction costs have been going up over that period. So I guess there are some encouraging signs, and I believe that we've demonstrated that we've got resilience to be able to manage through a situation of rising construction costs, particularly in a market where we've demonstrated we've got some room to move on price. And if you think about the increases in housing last year, some 30% or so, we were conservative in the way we put up prices through that period. And as a result of that, we've got some gap between the median prices in the market and the prices that we sell our units for. Does that answer your question?
Thanks very much. That's all from me.
Thank you.
Thanks, Stephen.
The next question, if we could, please.
Thank you. Yes, thank you. Your next question comes from Nick Ma from Macquarie. Please go ahead.
Good morning, guys. Just wanting to understand a bit about sort of settlements and what you're seeing at the moment. Receivables could step up a bit during the period, and sort of looking at the cash from new sales versus the actual sales numbers and the build in new sales debtors, there was a bit of a step up there. Could you just talk about that and whether there's been any changes to how or when you're accounting for those new sales? I couldn't see the sort of contracts not settled and contracts not booked in the press over time.
Dave?
Yep, perfect. So in terms of the basis that we're booking those, Nick, it is consistent with prior years. The lift in debtors is obviously just a function of timing of when people do move in. But in terms of settlements, we're not seeing any push out in timing of those at this stage. It is obviously something we monitor closely, but no, everything is at this stage consistent with prior years.
Thank you.
Next question.
Great. And then on the land bank, the land bank lifting, have you got any view on where that needs to get to hit your medium-term aspirations in terms of build rate? And on land bank, are you seeing any signs of better pricing signs come through given potential change to the housing market?
Well, of course, during the course of the year, we were very pleased that we were able to continue investing for the long term for the business. And I guess for us, this is one of the highlights of the result, not just the financial performance, but also being able to build for the future. And at the moment, we're very confident that we're on track with the amount of land we're buying into the business to give us that future proofing. But as you know, as you go through the planning and approval process, there are issues that can arise, but we believe that we've got the ability now with quite a significant land bank to be able to manage the ebb and flow, if you like, of new sites coming on stream. Dave, do you want to add anything to that?
No, I think that captures most of that. I think the key for us is we're always sort of looking to keep adding and stay in the marketplace for new sites. But we've also been focusing a lot on the consented sort of basis of our land bank, because that gives us certainty of our build numbers going into the next few years.
Next question.
Yeah, and sort of the second part around land pricing, any changes there?
In pricing of land?
Pricing, I don't think it has been yet, but it's probably something we are monitoring. You are just starting to hear some noise of sort of development land starting to come back a little bit, particularly in the back of construction costs. But yeah, that's something we are obviously monitoring.
Great, that's all from me, thanks.
Thanks, Nick.
Thank you. Your next question comes from Shane Sully from Harbour Asset Management. Please go ahead.
Good morning, everybody, and firstly, congratulations on the strong results. The team's really hard work looking after residents, and Dr. Kerr, thanking him for his stewardship. I've got 3 questions, if I may. Firstly, the care piece of your business is crucial. Care profitability has obviously been under pressure. The governments, both New Zealand and Australia, have been slow to support the work. Can you talk about what you're doing with your care offer going forward to lift or sustain profitability?
Hi Shane. Look, really good question, and clearly care profitability is something that we're focusing heavily on. I mean, care is underfunded. There's no doubt about that. We're really engaging with government to find a solution to that long term. I mean, as I mentioned in my opening remarks, 500 beds were lost in New Zealand in the last 6 months, which is quite concerning. We do, of course, have a vertical integration and continuum of care model, so our residents can take some solace from that we can provide opportunity for them. What I would say, though, is we're looking with interest of the most recent budget. $14.9 billion announced is the greatest we've seen for health over the last 4 years. And, we have got an ageing population, which is driving our growth, of course, and is front and centre for us. We're really interested to see, the finer detail of the $14.9 billion, over the 4 years. However, the Minister has repeatedly provided messages to support the growing population. So, like you, we're intrigued to see the finer detail on that. We think we're part of the solution, working collaboratively with government to provide an opportunity for the ageing population and the increasing care needs for the community. So we'll certainly be looking at that hard. Any other comments from the team here?
No.
Thank you.
Other
Just a second question, if I may then. Given the headwinds you noted in terms of growth, the flexibility and the development profile to actually deal with changes in conditions, could you just talk a little bit about that?
I think probably the fundamental dimension is that we operate a continuum of care model and a vertically integrated model, which means that there are several links in the chain which create value for us. And there is a natural ebb and flow, as we've just heard in the previous question. At the moment, the care component of this is under pressure, but our model is robust enough in that we delivered a result through the other elements of the value chain. And that therefore gives us a resilience that maybe some other players in the marketplace don't have. Dave, perhaps you've got some other views.
Yeah, and just to sort of add to that, Shane, I think if you look at the land bank, we are looking at the mix of our developments a little bit. We are a care business and we're very committed to care and looking after our residents, but we are just making sure we have that mix right, given the current sort of funding sources and levels in place.
And I think the particular focus, the area of the market that we focus on, which is towards the mid to upper end, the wealthiest generation in the history of mankind is now coming off into the ages of retirement, and it's a particularly resilient base of potential residents for us. And I think we're very well positioned, therefore, to capitalise on that. And that, to some extent, mitigates some of the headwinds that are prevalent in the market at the moment.
Okay.
Just a final one then. In terms of the capital structure for growth,
Sorry, Shane.
you addressed.
Sorry, Shane, just repeat that. It just broke up for us.
Sorry, guys. In terms of the capital structure to support growth, you have addressed or extended your debt, which is fantastic. Can you just talk about that loop back between the realisation and what capital structure you see as ideal going forward?
Yeah, I think with that, Shane, as we've sort of touched on before, we look at the debt and the composition of that debt, and it is to fund new villages that we are building, so our land bank and our villages under construction. We do make sure we actively manage that, and we are, making sure we have the appropriate funding lines in place. In terms of the capital management structure, we have announced in November last year a tweak to our dividend policy with a more flexible range with a 30 to 50% payout, and this year's dividend is consistent with last year, which does represent a slight decrease on our typical historical 50% payout. So that is making sure we keep a bit of more cash in the business to fund our future growth, but also looking at that debt. And the investments we are making, it's important we keep investing in our existing villages and resident experience too. When you look at that embedded value of $2.45 billion that's in our existing portfolio, that's cash we're going to free up in the next 5, 6, 7 years. And ironically, it's incredibly close to that overall debt number too. So we've almost got two ways of paying down our bank debt, through selling down our new stock as we build it, but also the cash that's pent up in our existing business.
Okay.
Thank you. Your next question comes from Andrew Steele from Jarden. Please go ahead.
Good morning, guys. The first one for me is on underlying rate of cost inflation. You've touched on there clear pressures on bill costs. What are your expectations for underlying operating cost inflation and for bill cost inflation for the year ahead?
I'll probably hand to Dave to actually answer that, but we do have a very, very strong supply chain and supplier base that we built up over many years, which gives us some comfort that we're well positioned to manage it. But there's no question that we're facing some of those headwinds. Dave?
Yeah, and I think if we look at the sort of overall cost pressure, like construction, the supply chain has been under pressure, and that is seeing costs lift. There's sort of talk of 5, 6, 7, 10% lift in construction. We are working with our suppliers and making sure we have really good sort of planning lines in place, and we're working with them to make sure that we sort of rein in any cost inflation that we possibly can. The key for us is also making sure we can sort of monitor the pricing that we're looking to achieve as well, to capture some of that as well. And then if you look at the operating sort of side of the business, CPI has lifted, and obviously that's something we are trying to address as a sector with the government through the aged care funding, to address that as well. But a lot of our cost inflation that comes through in the P&L is actually just us opening new villages as well. So about half of the increase in the operating expenses relates to new villages that have come on stream this year. And when you couple that with another sort of over $20 million spent on COVID, I look forward to one day us maybe not having to spend quite so much on that as well.
Australia, or?
Yeah, I think just to add to that, from the Australian perspective, we're obviously seeing cost pressures and inflation in construction products as well. I get the sense that it's not to the extent of the New Zealand region, and our long-term relationships and work we've been doing on procurement over the last 12 months and beyond has definitely set us up pretty well to be able to absorb that, but also to address the price rises on the other side as well to cover it. And I think going forward, we're a couple of months ahead on the COVID curve, so hopefully the COVID cost impacts that we've had over the last couple of years are starting to diminish, and we can look forward to a living with COVID moment where we've got that largely under control.
I think just to follow up on all your responses, if I look at the increase in revenue over the last year, which was 53 million, and then the growth in costs was 71 million. And so clearly, if you look at, I guess, an operating loss wedge opening up there, and given your fixed fee model and funding pressures, how should we expect this to develop into FY23? Should that gap open up further between revenue and costs, or would you expect that there's some elements in there which are COVID related, which we should see it actually close a little bit?
Yeah, I think there are very mixed signals we're getting about where costs are going, depending on where you look. I mean, I think, there are cost lines that are going through the labour line, obviously, with the cost pressures around people. The costs on PPE, for example, is something that's under particular pressure right now, obviously given the medical challenges. And then there's the construction cost increases as well. And there are very mixed views about how that's going to play out. A lot of it is dependent on global supply chains. And there is some evidence or some talk that this is more about, the location of products as it is about there is actually the materials in place. So I think it's a mixed picture at the moment as how those costs are actually going to play out. What I would emphasise, though, from the Ryman perspective, is just the mitigations that we put in place to be able to manage through that. We, being vertically integrated, we manage our own construction programs. We can decide when we start, when we release stages, how we do the refurbishments. We can, given our scale, we can also use that scale to be able to source alternative supply as well when things are in short supply. So it's a mixed picture, I have to say. Would any of my colleagues like to add anything to that?
Yeah, I can. I think in the Australian context, the other thing to keep in mind is that we do have a large number of developing villages. And so we opened up 2 new care centres just this year, and the other 2 are fairly relatively new. So that ramp-up period does take a bit of a time. But hopefully by the end of this year, those should be largely full. I think the other thing to consider really is that there is quite a lot of legislative change going on in Australia this year, and there will be some changes to the funding profile, largely with the main aged care funding instrument changing to the Australian National Aged Care Classification in October. Ryman's model on the continuum of care basis is reasonably well set up for that change, we should look forward to that funding change helping us beyond that October deadline.
Yeah, I think I'd add to Andrew is that we are laser focused on the costs as well. So we'll do everything within our power. And I think the other thing that was touched on by Richard was, given our network, we're able to move our supply around and phase that accordingly when it comes to supply and the demand of various products. So we're not immune to it, of course, but I think we're better placed than maybe some potential single operators, in that regard. Well, I know we are. So, but undoubtedly, it's something that exercises the mind of the team, and I've got confidence that we'll keep ahead of that curve.
Thank you. Your next question comes from Aaron Ibbotson from Forsyth Barr. Please go ahead.
Hi there. Good morning, everyone. And again, congratulations on a good set of results all around. I got a couple of questions on FY23, if sort of forward-looking, if it's possible. So first one, you talked to over 1,000 delivered units, which would obviously be a quite big step up from the last couple of years. And I'm just curious to know if there's anything you can guide us towards what you expect the sort of capex number to deliver those would be. And then I might as well run with my second question directly. And that relates to just your interest expense. If I heard you correctly, you mentioned that you had a third of your debt fixed. I was just wondering, does that mean that the sort of other 2/3 is fully floating? And, am I assuming the right thing if I'm assuming that this is going to drift up with the general interest cost in the market, or is there any other hedges or stuff in place that I should be aware of?
Perfect.
Thank you.
Oh, I can probably answer both of those for you, Aaron. So in relation to the CapEx question, we don't give specific guidance, but if you look at our CapEx this year to sort of deliver 700 beds and units, if you were to sort of extrapolate that out to 1,000 beds and units, you'd probably be in the rough ballpark. It's probably the easiest way to look at that. And then in terms of the interest expense, yes, you're right. So we've got 1/3 of it sort of is fixed. It does mean the other 2/3 is floating. It's something we continue to monitor. But I think just with the interest expense, it's one cost line that we do monitor, but there's a significant upside on sort of the other sides of the revenue line as well, in terms of the extra volume or development earnings we're going to generate from the lift in our build program, and also the sort of under-rented resale earnings this year, given the pricing increases that occurred during the year, haven't had the full benefit. So I think, there's plenty more upside to look at as well.
Very good. And specifically on cash, I guess if I look at resales cash flow versus the resales revenues, was roughly 100 million lower on the cash flow line. A lot of that was in the first half, but I'd sort of expected that to come back in this half. So I'm just curious to know, should we expect that sort of 100 million to come in with a delayed effect in the first half of 23, or how should we think about resales? It seems like, roughly 100 million of resales has gone into receivables.
Yeah, I think with that, and it's just important to remember around year end what was happening in the country with Omicron. So people were, I guess, just a little bit slower to move, and to particularly people that weren't necessarily selling their house. So we did see a few people just sort of delay slightly, and obviously we were a bit more mindful of when people could move into it, some of our villages. So yes, we would expect to capture that in the first half of this year.
Great.
Thank you.
Thank you. Your next question comes from John Boscoen from Versoik Custodians. Please go ahead.
Look, thank you for agreeing to take my question. I've got three quick questions. First of all, David, I noticed on Appendix 17 on page 40 of the presentation, you have the Deborah Cheetham Village Centre as being open. My understanding, that's actually still under construction. Am I correct?
It's both, of course.
Hey.
So the village is open with the independent units. So we have a village manager and a number of residents living on site already. And obviously the rest of the site is still under construction, including the main building and the care facility. So.
And this, of course, is the typical picture for a large number of our villages, because we take a very long-term view and open them in a series of stages. And the first stage at Deborah Cheetham is open and functioning with the team in place. And that will now, over the next few years, in fact, have a series of new releases and new stages to it. You had other questions, John, I think.
Look, and my reception on my phone is not very good, so you may not be able to hear me clearly. But the second question is, if I'm correct, you've delivered 419 units in the second half. Am I right in saying that only 8 of those, the 8 villas that were built at James Potty, were actually complete, and the other 411 would be units nearing completion? So 411 of the 419 actually haven't been finished.
Dave, you're probably well placed to answer that, but obviously we have, quite strict procedures for the way we judge what stage a individual unit is at. But Dave, do you want to elaborate?
Yeah, I need to double check that. But look, John, I think the key with that is the way we've assessed that near complete is completely consistent with what we've done in previous years. So we have got people moving into our villages right throughout the year, and a lot of those move-ins have been occurring in the last few weeks as well.
And I think, John, I think you've reached out to us, and maybe we could have a conversation at some point about those. I mean, they're quite detailed, some of those questions you've got there, and we'll come armed with the right information for you. So maybe if we could move to your third question.
Okay, and I would appreciate the opportunity to talk face-to-face. But my third question is, you've said that there is a record profit in Australia. As I mentioned in my letter to you, I was at the Burwood East Village 3 weeks ago. And, of course, the final apartment building with the 104 apartments, which you're saying is nearing completion, the structure's not complete, the roof's not on, the cladding's not on. By your own admission, you're telling your guests, your residents, that it won't be complete until November. In an environment of rising construction costs, how can you actually calculate the profit if the thing's only half built?
Yeah, John, maybe I could. As David has mentioned, we have a formal policy. It's consistently applied. We only book units with contracts, on those. And, the key judgments that we make, are made by management, the directors, auditors, and everyone's comfortable with that. And I think, as I openly mentioned before, you have reached out to us and we're happy to meet with you around the detail. But, the directors and the management and the auditors are comfortable with the position that we've taken on that judgment. So maybe if we could hold the rest of those conversations to when we have an opportunity to discuss them. Thank you. Okay.
Thank you. That does conclude the phone questions.
Brilliant.
I'll now head back.
Okay. If we could have the online questions, if there's any, please.
Yes, a question from Kim Santa. There's two bits to it. First bit for Dave Bennett. Referring to the income statement, revenues have increased by 228% in the last 10 years, but expenses have increased by 311%. What steps are being taken to reverse this trend?
Yeah, there's a lot of aspects that are involved in that. Obviously, the revenue number just includes the care fees and the deferred management fees. It doesn't include our resale earnings and development earnings, but the cost base does include a lot of the costs associated with generating those earnings as well. So it is something that we are obviously trying to look at, the cost base and how the revenue match of that. COVID's also had an impact on that as well, but the key is that there is a slight mismatch between that revenue line and the cost line associated with the resales earnings in particular.
Second question from Kim for Cameron. Mount Eliza suffered further consent problems during the year, and you've resubmitted your plans to VCAT. What's the potential left with this site given the downsizing of your plans?
Right, well, so during the year we obviously went to VCAT back in July, and we were actually quite pleased with, other than the decision in the end, but the response from VCAT at the time was that they did support our proposal, but just wanted some tweaks to the scale. So we're in the process of making those tweaks. We've resubmitted through council. That timeline has passed, and now we have resubmitted through to VCAT. There will be a hearing later in the year. They do take the previous decision into account in the next decision. So we're looking forward to pleading our case once again later on this year, and hopefully we'll have a result towards the end of this year.
Thanks, Cameron. Question from Andrew Ott for Dave Bennett. Clarification on payments to residents of $346 million. What is this for? Is it a refund of the 80% occupation right when the unit apartment has been vacated?
Yes, that is correct. That's what that relates to.
One more question. This is from Joshua Litton for Cameron. Why has Ryman purchased another site in Coburg North when a year ago it sold another site in Coburg in arguably a better location or demographic? And second part, is David Bennett still managing development after Mr. Moore stepped down in September?
Yes, so thanks that's a good question. I think the Coburg area is one of distinct interest for Ryman. We think it's a great location, obviously, and one that really fits well within our strategy of buying in premium locations close to urban centres. So it's 6 hectare sites within 15 k's of Melbourne don't grow on trees very often, and this site at about 2.5 hectares is a fantastic size for us in our model going forward. I think in terms of the site change, what we did notice, and part of the analysis on the previous site, was the capital intensity required to build a site like that, which was, I think, in the plan was originally for 11 stories. I think the right decision was made that was not the right time to invest that much capital in one site in our current growth plans in Australia. And frankly, I think that's a mature sign of great portfolio management, and I can't take any credit for it because it all happened before I arrived. But I think it was a perfect decision, and now that I'm really excited actually that we found a site that we can invest in stages and release in a pattern that has appropriate capital velocity and one that is in an area that we know is a rapidly changing demographic with a very high median house price and a great part of Melbourne.
The second part of that was the development in New Zealand. So Chris Evans, our Chief Construction Officer, is currently looking after the development aspects of the business instead of me.
No more questions from the web.
Right.
Thank you.
Well, thank you. I'll just maybe conclude and we wanted to offer a really sincere thanks for your time and attention today and for your great questions. As I mentioned, we're proud of what has been a strong result delivered during a very interesting period of considerable disruption. The resilience, the commitment and professionalism of our team played a key role in helping us respond decisively to these changing circumstances. we look forward to reporting back to you in 6 months' time, and seeing a number of you, of course, at our AGM. So I just wanted to pass on our thanks, wish you all the very best, keep COVID safe, and we look forward to seeing you again shortly. So kia ora and all the very best.